You know, we often talk about governments, politicians, central banks, but there's this other force kind of behind the scenes that's incredibly powerful.
Oh, yeah, the bond market. It doesn't always grab headlines, but its influence is massive.
Totally. And if you're trying to get a handle on this stuff quickly without getting bogged down, well, that's what we're aiming for today.
Because we're going to take a deep dive into the return of the bond vigilantes. That term came from Ed Yordini, the economist, way back in the 80s.
Very vigilantes. Sounds dramatic.
Well, it kind of is. It's not like a hidden group. It's more the collective power of investors, big funds, institutions. And they basically make their feelings known by pushing bond yields higher if they think a country's finances are, going off the rail.
And they've been making a comeback lately, apparently.
Definitely. Been quite noticeable.
Okay. So our mission today, and we're drawing heavily from a really interesting piece in Nexus Chain News, is to figure out how these bond vigilantes work.
And crucially, what their recent actions might be signaling about, well, the whole global economy.
Exactly. So let's get into it. The Nexus Chain article kicks off with a pretty startling event, a recent, very sharp rise in U.S. 10-year Treasury yields. We're talking 49 basis points in just 1 week. That sounds fast.
It is fast. Very fast. The article points out, and it's right, that this was the quickest spike in over 20 years.
Wow. 20 years.
Yeah, to give you a bit of context, you have to go back to the period right after the dot-com bubble burst in 2001 to see yields move that quickly. It definitely signals a significant change in investor mood.
And what apparently triggered it, according to the article, was all the talk and action around tariffs from the Trump administration. Now, normally you'd think uncertainty means people rush to safe U.S. treasuries, wouldn't you?
That's the textbook reaction. Absolutely. Flight to safety. But we saw the opposite happen here, which is fascinating. Investors actually started selling U.S. government bonds. They weren't looking for safety there. They were moving away.
Why? It was a fear.
The article explains it well. Bond investors were worried about inflation picking up because of the tariffs and just general fiscal instability. What does this mean for the government's budget down the line?
So by selling, they drove the price down and the yield up, essentially demanding more compensation for holding U.S. debt because they saw it as riskier.
Precisely. It's like the market suddenly demanded a higher risk premium. And the Nexus Chain piece really stresses how significant this was.
It wasn't just a blip.
No, it was the market saying, hold on, that automatic trust in U.S. fiscal management, maybe it's not so automatic anymore.
Yeah.
There's a real shakeup of that assumption.
And this wasn't happening in a vacuum, right? The article mentions stock markets were falling at the same time, world leaders were voicing concerns.
Correct. All interconnected.
But here's the really crucial part, the article suggests. It wasn't just diplomatic whispers that caused President Trump to pause on more tariffs. The bond market played a role.
That's a key insight from the piece. The pressure from the bond market itself, this sort of impartial, financially driven force, was a major factor in that policy decision. It's a textbook example, really, of these bond vigilantes flexing their muscles.
So the market itself can kind of discipline governments. It's not just voters or other countries.
That's the idea. And it's not entirely new either. The article throws in a great historical parallel. Back in the 90s, President Clinton's team was explicitly warned about these bond vigilantes.
Warned what?
That if they didn't keep the budget under control, these market forces could basically sabotage the economy by driving up borrowing costs. So, yeah, this dynamic has history. They just seem more awake now.
More prominent, yeah. Okay, speaking of dramatic market reactions, the article then pivots to something more recent. The UK's lettuce moment.
Ah, yes, a cautionary tale for sure.
How does that connect?
Well, remember back in 2022, the Prime Minister then, Liz Truss, rolled out this budget with huge tax cuts, but no real plan for how to pay for them. Unfunded.
I remember the headlines. What did the market do?
It reacted instantly and brutally. UK bond yields, they call them gilts, just soared. Investors dumped UK assets. Confidence just evaporated. It was chaos for a bit.
And that's where the lettuce comes in. The Nexus Chain article mentions the tabloids.
Yeah, it was a bit surreal. A British tabloid started a live stream of a head of iceberg lettuce next to a photo of Truss asking which would last longer.
Chuckle slightly. Seriously.
Seriously. And it kind of perfectly captured the market's utter lack of faith in her plan. And, well, the lettuce won. Truss resigned after only 44 days.
Wow. That's a powerful, if slightly absurd, symbol of market power.
Absolutely. It shows just how quickly and decisively the market can react when it thinks a government has lost the plot fiscally. trust vanished.
Okay, maybe let's back up for a second. For anyone listening who doesn't live and breathe this stuff, why are government bonds so important? The article calls them IOUs, basically.
That's a good way to put it. Governments issue bonds to borrow money to pay for public spending, roads, schools, defense, everything.
And there's a lot of this borrowing going on.
A staggering amount. The article mentions global government debt is expected to top, what, $100 trillion in 2025?
$100 trillion, that's hard to even picture.
Right. So the bond market, the people buying and selling all this debt, they essentially become the gatekeepers of a country's financial credibility.
And it's not just abstract numbers. The article quotes a financial analyst, Priya Desai.
Yes, she makes a great point. Rising bond yields aren't just a problem for finance ministers.
How so?
They feed through directly into things like mortgage rates for homeowners, interest rates on credit cards, and of course the cost for the government itself to borrow more money. So if a government relies heavily on borrowing,
Which many do.
they become very vulnerable to these shifts in market sentiment.
And the buyers of these bonds, the article mentions pension funds, hedge funds, even other countries' central banks, they're getting more nervous.
They are getting more cautious, yes. Worries about inflation just not going away, plus these ever-growing piles of debt. It's making them demand a higher return.
That risk premium again?
Exactly. They want to be paid more for what they see as a growing risk in lending to some governments.
Which leads to another fascinating point in the nexus chain piece. This idea that the ultimate safe haven might be shifting. For ages, U.S. Treasuries were seen as the safest place on earth to park your money. Is that changing?
The article suggests there's definitely a shift happening. Maybe not overnight, but you see investors increasingly favoring German government bonds.
Why Germany?
A big reason is their debt situation. Germany's debt relative to the size of its economy, the debt-to-GDP ratio, is much lower, around 60%. Compare that to the U.S. or the U.K., where it's over 100%.
So investors see Germany as more fiscally disciplined?
That seems to be the perception, yes. More prudent management.
And you can actually see the shift in the yields.
Yeah, the article points to the widening gap, the spread between the yield on U.S. Treasuries and German bonds. Investors are demanding a noticeably higher return to hold U.S. debt compared to German debt.
The article calls it a subtle but significant vote of no confidence in how the U.S. is managing its finances. That's quite a statement.
It is strong language, but it reflects that perceived difference in risk. Now, when yields rise like this, governments often try to push back, don't they? The article talks about quantitative easing, QE.
Right. QE. Can you briefly explain how that's supposed to work here?
Sure. So QE is basically when the central bank, like the Federal Reserve in the U.S., steps into the market and starts buying up government bonds itself.
Okay, why?
By creating this extra demand, they hope to push the price of bonds up. And bond prices and yields move in opposite directions. So higher prices mean lower yields or lower interest rates.
And the Fed did a lot of this after the 2008 crisis and during COVID too, right?
A huge amount, yes. The article mentions that.
But it's not a magic wand, is it? The article cautions about downsides.
Definitely not magic. QE can have unintended consequences, like it can inflate bubbles in other assets, stocks, housing, because there's so much cheap money sloshing around. And it can kind of distort how markets are supposed to work.
The article uses Japan as an example of the limits.
Yeah, Japan's had decades of near-zero interest rates and massive central bank intervention, but it hasn't exactly translated into roaring long-term economic growth.
Yeah.
It shows QE isn't a guaranteed fix.
And there's a quote in the article from economist Linda Ng about a crucial condition for QE to even work against rising yields. It's all about inflation.
Exactly. Her point is critical. A central bank can try to fight rising yields by buying bonds if, and it's a big if, inflation is already low and stable.
My only then.
Because if inflation is already high and the central bank starts essentially printing money to buy bonds, it risks making inflation even worse. That could totally destroy its credibility and maybe even tank the currency. It's a really fine line to walk.
Okay, another layer the article brings in is the U.S.-China relationship. China holds a ton of U.S. debt.
A huge amount. Over $700 billion worth of U.S. treasuries. It's definitely a point of leverage or potential leverage.
So there's this fear, right, that China could weaponize its holdings, just dump them on the market.
That fear definitely exists.
Yeah.
A massive sell-off could theoretically cause chaos and send U.S. yields skyrocketing.
But Linda Ng, the economist quoted earlier, she pushes back on that idea.
She does. Her argument is that it would be kind of self-defeating for China if they dumped all their U.S. bonds. The value of those bonds would plummet, including the ones they still hold.
She calls it like nuking your own savings account.
That's the quote. A very vivid way to put it. So a sudden, massive dump might be unlikely because it harms China too.
Oh.
But even the possibility of China selling gradually, or just not buying as much in the future, adds another layer of geopolitical risk that the bond market has to think about. It's part of the equation now.
Okay, so wrapping all these threads together, persistent deficits, political tensions, inflation worries, shifting investor preferences, geopolitical factors, the article poses a pretty stark question. Could the U.S. face its own lettuce moment like the U.K. did?
It definitely raises that specter. It draws parallels between the market revolt against the Truss budget and the current unease simmering in U.S. markets.
Are the situations comparable, though? The U.S. economy is huge. The dollar is still dominant.
True. The article acknowledges those strengths. The U.S. is not the U.K. It has a much larger capacity to absorb shocks, and the dollar's global role provides a buffer.
But the warning is there.
The warning is definitely there. The underlying message seems to be that investor patience isn't infinite. Trust, once it starts to fray, is incredibly hard to win back. The market's skepticism is real.
So the big takeaway here seems pretty clear. The bond vigilantes are not just some dusty old economics term. They are back, they are active, and in this age of massive debt and, frankly, unpredictable politics, they are a force to be reckoned with.
Absolutely. They're holding government's feet to the fire, demanding fiscal accountability. The market is sending signals,
Loud signals, it sounds like.
and governments ignore those signals at their peril.
Which really leaves you, the listener, with something to think about. We've talked about the power of this market, right? So what other kinds of events, maybe policy surprises we haven't even considered, could potentially provoke an even bigger reaction from these bond vigilantes down the road?
And maybe more fundamentally, what would the fallout be? Not just for the government finances we've discussed, but for everyday people, for your own financial situation, for the stability of the whole global system. Definitely some food for thought there.